This is a video about Apple, part of the continuing weekly features series on a stock. So this will be a fairly quick assessment. First off, we want to look at the primary factor that goes into determining the valuation, practical valuation here of $180 in resulting with the practical investment return you can expect as an investor. The primary input is sales growth, and so when we look at the default sales growth of 6% compared to the industry average of 2%, and then compare that to the S&P 500 average forecasted sales growth of 3%, the industry and the default seem a little low for Apple. So I'm going to start off with the industry, is why it would show an industry growth so low for a company like Apple. So come down here and look at what industry Apple is considered to be part of, communications equipment. That's a little odd because communication equipment industry includes companies like AT&T, T-Mobile, Sprint, Verizon, companies like that. And I think more appropriate for Apple to think of them in light of computer companies or even software companies. And those kind of companies typically have sales forecasts of anywhere 10% and higher. So first off, the industry standard is more of a 10% number at least. So now Apple's below even an industry standard of 10% when you consider that Apple's an industry leader in what they do. Why wouldn't their growth be at least the average, if not a little bit above? So if we go look at the CNN site to see what it's forecasting for sales growth, you can see here it's something around 15%. So that would mean that we probably want to move this up some. Now, why would Polaris only be coming with a default of 6%? Well, any sales growth above 12%, Polaris will dampen it down at least by a third, because analysts tend to be overly optimistic. Typically, most of the analyst type forecasts that are available for free out there, the one we just went and looked at off the CNN site, are from sell-side analysts, and the studies have shown they tend to be 30 to 40% overly optimistic on average, and then typically by the time the quarter starts to come to a close or the fiscal year comes to a close, their forecasts for that fiscal year all of a sudden are adjusted and start to align more with the reality or the actual growth that's likely going to be reported. But I'm going to assume that what we're looking at is still a year-out type forecast. Apple's, by the way, their fiscal year ends here in a couple of weeks, so I'm not saying that we're already seeing an alignment. I think we're looking at forecasts that are a year out. All right, so 6% just seems like it's been dampened down a little too much. I think it's more appropriate to take it back up to maybe not all the way to 15, but I'll take it up to 12. And then we can see here that we get now a market practical return that is exactly equal to the expected market return based on the current price. So we're exactly even with the market just by moving it up to 12%. Now, is there anything else that would want to maybe consider adjusting? It goes into the valuation formula. Well, the things that the other input values are share issue trend. Apple has announced that with this enormous amount of cash they have on their balance sheet, that they are doing some pretty aggressive sales or share buyback. So that percent there seems appropriate. The profit margin, future profit margin, is the same as the current profit margin. President Trump is talking tariffs and asking companies to move their manufacturing back to the United States. I don't think either one of those is going to immediately impact Apple. I don't think there's really any chance that Apple would move much of their manufacturing back from other parts of the world. So I think that profit margin for the future is in line. The other input parameter is PE, and that one that seems low because if you recall, the PE video that talks about this parameter specifically, that a PE is typically around 15, an average company is 15 historically. And what causes a PE to drop below that? Two things. Either the market perceives a higher risk than the average for the market in terms of future cash flows, that there were more riskiness, or they could be assuming a negative growth that would drive down a PE below 15. Well, we don't have negative growth here for Apple, so it must be a lower than 7%, which is a typical rate of return that would equate to a 15% PE. And you can see here over the last couple of years that the calculated expected rate of return based on riskiness is 8.5%, and that's, you know, if that's continued into the future, that's probably where the 13.7, if I were to plug it into the formula, it would probably come out close to 13.7. So I think that's, as far as a future outlook, 5 years out, that's probably not an appropriate PE to be using. I know that the current expected rate of return based on riskiness is 8.5%, but just don't see that continuing into the future. I think a number like 15 would be more appropriate. Why I'm thinking or saying that is I think back to Warren Buffett through his investments into Apple through Berkshire Hathaway. He's said that one reason why they've become the largest outside stockholder of Apple is that he feels that Apple is no longer a high-tech company. They're really a consumer products company, and with a very loyal customer base, and feels like that because that loyalty and the size of that customer base makes it a much less risky type of investment than it used to be. So I think 15 would be appropriate. Now, beyond 15, companies that have strong brand recognition, things like which Apple does, you can typically associate another bump in future PE of about 5%. Now, where that bump comes from is that they, with a strong brand recognition, it can be expected that they will continue to earn a high rate of return on their investments, and therefore when they do hit more of a saturation in the market, they can cut back on reinvestment because to maintain or just to produce at the demand that they're seeing 5 years out. So they don't have to continue to reinvest as heavily as maybe other companies would, because they're going to continue to have above market rates of return on their projects because of the brand recognition. So I'm going to add a total of about 15% on top of this, and gets us closer to about 15-16 PE. So if I come back up here, and if you've watched other videos, you know how to adjust this growth slider to account for difference in opinions and other factors besides sales growth. Well, if I'm going to assume the valuation will bump up by 15%, that takes it from 222 to roughly 250. So I'm just going to move the slider till I see 250 or close to it, and now I see a practical return of 11.2%. Well, there's only two other values that I can think about changing. One is the length of time that I think Apple may stay in this 12% growth state, and a lot of competitive pressures on Apple. You know, they are now $1 trillion market capitalization. When you're that large, it's very hard to continue to grow at above market rates. So I really don't think, if anything, maybe I should lower it down from 5 years. That's the default length of time. But I'm not going to take it up to 7 years or 9 years for a company like Apple. I'm going to keep it at 5 years. And then the last input value would be the cost of capital. But as we've talked about on other videos, that really doesn't change the practical investment return. So I'm not. I can do it to just see if maybe a different present value, but really the main factor that can be used whether to go forward or not is the practical investment return, and changing this number, just the cost of capital, will not impact this number, so I'm not going to change it. So I feel that 11.2% looks reasonable, but also need to consider the riskiness of the cash flows. So you can see here historically it's 8.5%. And another thing I want to point out is that Polaris is identifying Apple as a stable company, which means that its capital structure and other things about its operations seem to be not changing a lot. At least they haven't recently. So that kind of lowers the risk associated with this practical return of it, whether you're going to be able to actually achieve this practical return of 11.2%. The other thing is up here with the price momentum, you see a lot of recent enthusiasm around Apple. Stock's down a little bit today here on the 12th of September 2018, but over the last 3 months there's been some pretty good optimism, and really over the last year there's we know that stock of the Apple price has gone up quite a bit. So that's a good sign. But I want to go back to this historical 8.5%. and whether I feel like that's a good categorization of risk. I assume that it's not already by adjusting the PE, but I just want to go into a little bit more about just thinking through, okay, we've locked in on 11.2% return. What kind of riskiness do we really associate with achieving that 11.2%? Well, one way to look at that is to look at the calculation. And I haven't done this on other featured video stocks up till now, but this is showing that a beta of 1.04, and you can just see here that for every dot on this graph, it's just saying, hey, when Apple had a negative return, the market also had a fairly negative return. When Apple had a very positive return, the market had a positive return. And then the straight line is just an attempt to have a line that represents this relationship between how Apple did and how the market did. Now you can see that the actual dots are fairly dispersed around that blue line. And by the way, the blue line, the slope of that line is the beta, which is 1.04. But in order to measure how well that blue line really represents the dots, there's a statistical value called R squared, or the Pearson factor, that represents how well it fits. Now, in the physical sciences, you typically, for a good cause-effect relationship, you would like to see it, 90% or above. But in the social sciences, like finance, anything really above 10% is considered to be a fairly good fit. And so a beta of 1.04, and this is over the last 3 years, seems to indicate that the Apple has its stock price changes about the same amount as the overall market. Now, on average, a company's price change is about 70% explained by the overall market, but it seems like Apple's getting to the point where their price movement is even more explained by the overall movement in the overall market. So that makes me feel that we should be looking at more like a 7% number in terms of categorizing the risk of Apple going forward. Now, another way we can look at it is to go off and look at the price of Apple. I'm going to go ahead and go into the chart, and I do have it compared to the S&P 500. The darker line is what we've seen over the last year as it relates to Apple, and then the lighter blue line is what the market's been doing. Now, I'm not going to get into technical analysis. I'm not a real believer in technical analysis, but primarily why we're looking at it this detail is this: does it look reasonable that Apple is becoming more and more the price just moves with the overall market? Now, over the last couple months, that's visually doesn't look like it's quite as true. It looks like the market, or Apple, has moved up considerably more than can be explained just by the movement of the overall market. But going back a couple months, it looks like it is fairly aligned. So I think this overall says that the riskiness of the stock is more in line with the overall market, and the overall market riskiness is 7%. So I feel good that we should categorize the riskiness of being more around like 7%. And so if we can make 11.2% on what, as far as this risk return, should only be maybe a 7% return, this looks like a favorable stock. So all things considered, say Apple is a prospect. Thanks for watching.